My name is Paul Siegel. We are Starweaver Group. This webinar is being conducted on currency derivatives and equity markets. It will be facilitated by Doug Carroll, who will take the baton shortly and start. I'll tell you a little about Starweaver. We are an education company that focuses on finance, technology, and other training for professionals around the world. The idea of education you can bank on is that you get absolute certainty in the quality and the level and the detail of the kind of programs that you participate in or experience with us. These are some of the many clients we work with around the globe, from the Australian financial institutions to the Indian technology companies, et cetera, et cetera. Most of what we do is for organizations and not for individuals, but you can go and you will see shortly how you can participate in the program individually. Most all of our programs are hands-on and live, taught by experienced practitioners like Doug Carroll, and customized to the audience. But we do have a library of courses as well, and as I said, I'll pass you on to that, and you'll be able to see what those are in a moment. There are 5 domains: leading IT, enterprise IT, project management, business skills, and finance and banking. Of course, this is a finance and banking webinar. If you complete the survey at the end of the program, or you'll see it in the chat box at the right, Rand has posted there, you'll get access to one of these 17 or so courses. Doug has created a bunch of these with us. So they're video-based courses. They're extremely good. They're sliced into short components, and therefore you can use them and refresh yourself at any given time. Again, the survey link is here, and you'll see it on the right. We'll have a bunch of additional webinars coming up and announced in the next days. You'll get emails about that as well. And you'll also get a copy of this webinar sent to you as a link, which you can access after the program. Doug will tell you a little about himself once he gets going, but suffice to say, I've been working with Doug for many years and have only the highest regard for both his expertise and knowledge, and more importantly, that based on a love for training and education and his way of communicating that. If you have any questions, just contact us, Paul Siegel or Rand Shanik. I will pass it over to Doug and have him take the program from here.
Thanks, Paul. Well, welcome to all participants. As Paul indicated, this session will be on derivative, currency, and equity markets. As you might gather from the title, this week's session is even more ambitious than last week's when we were able to focus on just fixed income securities markets. Before giving a brief overview of what to expect, to follow up on Paul's promise, I will say a little bit about my background. So I've been in and around the financial businesses for about 40 years, the first 20 of those bouncing back and forth between the trading and training side of the securities and investment businesses. So I split it about half and half between working in environments like bond trading desks, asset management positions and sales, and research, and heading up training units, in some cases internal training units at places like Citibank, where I manage the investment training group for both the retail broker-dealer and the global investment bank, or financial training organizations like the New York Institute of Finance. For about the last 20 years, I've been an independent trainer and investment consultant, focusing on the type of things we're going to talk about today. So without further ado, let me give you a brief overview of what to expect for this session. As indicated, we're going to divide the session up amongst the derivative markets, currency markets, and equity markets. Given the gargantuan size of those markets and limited time, I'm not going to go into excruciating detail on specific instruments traded in any of those markets. Rather, I'll try to give you broad characterizations of the features that distinguish one market segment from the other, and some of the important contract features that characterize and maybe distinguish between the instruments traded in each of those segments. So broad concepts and a little bit of terminology is maybe the most we can hope for, given the range of topics we're going to talk about today. So let's start with derivative markets. We'll spend about half of the session with derivatives, and we'll split the remainder about 50-50 between currencies, and then close up with equities. Oops. All right. So While there are literally thousands of different variations of derivative contracts, boiled down to their bare essentials, there's really only two types of derivatives. As indicated on this page, there are forward commitment contracts and contingent claims. Oh yes, there are thousands of variations of either type, or in some cases that combine the two. But to get a broad understanding of the primary distinguishing features of the derivatives one from the other, let's talk about that briefly. And this is way beyond a simple academic classification, because if you can identify the key features that distinguish one from the other type of the two categories of derivatives, it gives a good basic understanding of the potential change in value, as well as the beginning of an understanding of the pricing and valuation of the different sorts of contracts. So forward commitment contracts are futures and forwards and the forward commitment swaps, which you see listed there. That is interest rate, currency, or more properly cross-currency, commodity and equity swaps. Those are the forward commitment contracts. And the contingent claims are options of all sorts, from the most basic plain vanilla put or call to the most obscenely complex exotic option, some sort of double barrier knockout or knock-in option. No, we don't have time to talk about those in detail. And despite the fact that swap is in the name, credit default swaps are distinctly different from all of the other types. As we'll see, credit default swaps are much more akin to options, whereas all of the other swaps could actually be viewed as generally packages of futures or forward contracts. For instance, a 2-year quarterly settled interest rate swap could really be analyzed as a package of 8 forward contracts, one deliverable in 3 months, another at 6 months, 9 months, 12 months, etc., all the way through the end of that contract. Now, what are the key distinctions between the two types? Well, the key word in the first group, the forward commitment contracts, is commitment. So for any futures or forward contract or forward commitment swap, both counterparties to the trade, the long, the short, the buyer, the seller, the fixed rate payer, the fixed rate receiver. So the terminology varies across the different types of contracts, but as we'll see in a little bit, in all derivative contracts, there's always two counterparties. And in a forward commitment contract, the two counterparties are making a legal commitment. In other words, they are incurring a legal obligation to do something, and failure to honor that contractual commitment would open them up to legal liability. They could be sued by the counterparty for failure to honor their contractual obligations. Now that's pretty abstract. Let me be more specific. In a futures or forward contract that has a physical delivery feature, and not all do, but most do, but in a futures or forward contract that has a delivery feature, the seller or short is obligated to make delivery. The buyer or the long is obligated to take delivery. So they're exchanging those obligations to make and take delivery. Or to give you a swap example from a plain vanilla interest rate swap, a fixed for floating rate interest rate swap, one party is committing to pay a fixed rate of interest to the counterparty, and the counterparty receiving a fixed rate of interest is obligated to pay a floating rate of interest to the counterparty. So without going into any more detail, because it varies again from contract to contract, but in any forward commitment contract, both counterparties are incurring a legal obligation to do something. Now, implications of that? Well, think about it. If the counterparties are exchanging equal but opposite obligations at fair value, that's sometimes referred to as at market, or in the case of interest rate swaps, that would be what's called a par swap. The vast majority of these forward commitment derivatives are entered into at market, in other words, at fair value. And if counterparties are making an equal but opposite exchange of obligations at fair value, which counterparty has an advantage? Well, of course, if they're exchanging equal but opposite obligations at fair value, neither counterparty has an advantage. Guess what that implies about the initial value? Well, such contracts done at market have a zero initial value. Now, some might think, well, that's sort of a curious, theoretical curiosity, but who cares? Well, if it has no initial value, that means you can take the position at no cost whatsoever. And think about what that means or implies about the exposure one can create in the market. Now by exposure, I mean you have a position in the market. Once you have a position in the market, you have potential for gain or loss, depending on how the market moves after you've created that exposure. Well, to create $10 million of exposure in the U.S. Treasury market, I've got to come up with $10 million, either on my own or convince someone to lend it to me. I can create the equivalent exposure, $10 million worth of exposure in, say, Treasury futures without paying anybody anything. Oh yeah, I'll have to meet a margin requirement, but I can meet the margin requirement in interest-earning assets like T-bills that I keep collecting interest on. So that zero initial value, that implies a great capital efficiency. You can create lots of exposure for basically no cost whatsoever. Now, what about the contingent claims? Well, CDS are fairly complicated, so I'm not going to try to explain them in detail here. But most have probably previously had some exposure to plain vanilla options, puts and calls, where the buyer has the right to do something, that is, the buyer of the option has the right to do something. The seller of the option incurs an obligation. Let me be more specific. Let's say we're talking about call options. The owner of the call has the right to buy at the strike price. The writer or seller of the call has the obligation to deliver the related asset at the strike price. Note the inherently unequal exchange of contractual positions, or the inherently unequal contractual relationship between the two. One has the right to do something, the other has incurred the obligation to do something. Well, guess what? That means options should never have a zero initial value. The right to buy or sell, in the case of a put, always ought to have some value to it. And let's look at the next exhibit to emphasize those points. So you'll see in this slide, in the four corners, we have panels that illustrate the gain-loss profile or exposure profile for the four basic option positions: long calls, short calls, long puts, and short puts. The middle panels in each column show the gain-loss profile or exposure profile for positions in the underlying asset, that's the asset or commodity related to the derivative contract. But you'll note those middle panels, say the middle panel on the left, that says long underlying. In other words, that's like owning the stock or owning the commodity. But the same would be true whether you were long a futures or forward contract on that commodity or security, or if you were the fixed rate payer on an interest rate swap, or the total return receiver on a total return swap. So, and just to make sure everyone follows the diagram, we're measuring gains or losses on the vertical axis by displacement above or below the horizontal axis, gains above, losses below. And the horizontal axis represents the price or value of the underlying asset, the asset related to the derivative contract. So you'll note that in those cases, the crosshatch represents the price at which the position was initiated. For a long position, whether in the related asset, underlying asset, futures or forward contract, or again, fixed rate payer or total return receiver, as the underlying value increases, there's increasing gains, but as the underlying value decreases, there's increasing losses. And obviously the opposite would be true on short positions. Short positions see increasing gains in declining price environments and increasing losses in rising price environments. Now, if you didn't fully follow the earlier discussion, you might say, well, what's the benefit of having a derivative position that gives me the same gain-loss profile as I could get by trading the underlying asset or commodity? Well, that goes back to that capital efficiency I talked about before. To take a long position in a commodity or security, you've got to pay for it in full with your own money or possibly with borrowed money. But you can create equivalent exposure by taking a position derivatives without paying anybody anything, at least if it's done at market as talked about before. And of course, you might want to create those exposures simply to position, to take a bet or take a position on how a price might change. But you also might use a forward commitment derivative to hedge. So if I'm long the underlying asset, middle panel on the left, and I want to protect myself because I'm fearing the market's going to decline dramatically, I could short a futures contract. Well, you'll note now I've got these positions that have symmetric gain-loss profiles that show increasing gains and losses in one direction that will offset one another. So that's one of the primary purposes of derivative contracts is that hedging. Now you'll note that the contingent claims, the corner panels at the top and bottom of both columns, show increasing gains or losses on one side of the crosshatch. In these cases, the crosshatches would represent the strike price of the option, or in the bottom two panels, the notional value of the credit default swap. Well, the side of the crosshatch where there's increasing gains to the long and increasing losses to the short, that's on the in-the-money side of the option using the options market lingo. And on the other side, the out-of-the-money side of the strike, there's a range of values over which the gain to the seller is constant and the loss to the buyer is constant. And approaching it from the buy side, because that might be easier to understand, say we're looking at the upper left-hand panel, long call. Well, if I buy a call option, if the price goes down, I simply wouldn't exercise the option, because a true option gives you the right but no obligation to exercise whatever contractual rights the contract conveys. So that's why limited gain to the downside, because as long as I'm acting rationally, if the option is out of the money, I generally not want to exercise it. Conversely, if the price of the underlying goes up, I'll see increasing gains. Note, however, there's a cost to that. If I bought a stock and there was no change in value, I'd walk away with all of my initial capital intact. If I bought an at-the-money call option and the price of the underlying was at the strike at expiration, it's not a no-loss situation because now I would be out the cost of buying the option itself. So all the contingent claims have those symmetric gain-loss profiles, whereas all of the forward commitment derivatives have symmetric gain and loss profiles. Now, let's talk a little bit about what distinguishes derivatives from securities, because the differences aren't obvious when you're new to the business or unfamiliar with the financial markets. I was probably in the business for 5 or 7 years before I had a really strong understanding of the difference between derivatives and securities. Oh, of course, I recognize the terms. Options and futures were derivatives and stocks and bonds were securities, but those are names. Those don't tell you or give you any indication of what the significant differences are. Now, some of the differences that I'd mentioned before are captured in slide 4 here. Note, Paul, can you hear me?
I can hear you now, yes.
Okay. Okay, how far back did my connection cut out?
About 1 minute ago.
Okay, so let me resume. Sorry about that, folks. I just lost my internet connection for a second. All right, so the implication on the diagram under derivatives is that for every contract in existence, there's someone who's long and someone who's short. And that means that there are of necessity, by the nature of the way derivative contracts are created or offset, there must always be an equal number of long and short positions. And given that there's an equal number of long and short positions, that means the gains on one side of the market of necessity must be equal to the losses on the other side of the market. Simple example to bring that abstract description to life, hopefully. Let's say we're looking at U.S. Treasury futures and interest rates are falling, so bond prices are going up. When you look at all of the outstanding Treasury futures contracts, the gains to the longs must of necessity be exactly equal to the losses of the shorts. Without going into it in great detail, futures positions are marked to market and settled daily in cash. So if Treasury futures are up, the longs are going to have gains deposited to their account shortly after the close of that trading session in cash. Guess where the cash is coming from to pay the gains to the longs? It's coming out of the accounts of the shorts. So of necessity, by the way contracts are created and offset, in any segment of the derivative market, there's always an equal number of long and short positions, which means net, there's no change in value. The gains on one side of the market equal the losses on the other side of the market. Now, don't confuse number of longs with shorts with numbers of buys and sells. Of course, in any market, whether it's a derivative market, a security market, or for that matter, a flea market, a transaction doesn't take place unless there's both a buyer and seller that have agreed to do the trade. But if you look at the diagram under the heading of securities, securities are issued by, well, issuers. I've got a corporation here that might issue equity or debt securities. Issuers can also be governments or government agencies that would sell debt rather than equity securities. But securities are sold by some issuer, therefore they represent a claim against that issuer. And so consequently, once these securities are issued and outstanding, they're traded by investors. And yes, investors can sell such securities short. But in any real-world issue of securities, the number of long positions are a big multiple of the number of short positions. Even some stock like Netflix, which at times has been viewed askance by investors, saying, well, how can a company that concentrates on video streaming, and yes, Netflix does some video production, but most of their money comes from video streaming, how could such a company compete with Google or an Apple or an Amazon that can subsidize their streaming business with profits from cell phones or ad revenue or retail sales, as the case may be? So, and I'm not saying Netflix has been a bad investment over time. It's actually been a very great investment. What I'm sharing with you is the investment thesis that a lot of those with bearish views on Netflix have had, and so they'll short sell the stock. Well, even stocks like Netflix that at times are heavily short sold, the short interest, that is the number of shares sold short versus the number of shares outstanding, the short interest might be 20, 25, 30% of the shares outstanding. But that still means even for such issuers, the number of long positions is 3, 4, 5 times the number of short positions. And for the typical publicly traded company, the number of shares sold short may be only 1 or 2% of the shares outstanding. Since we don't have time to go into it, I can't explain all of the mechanics as to why that would always be the case for real-world issues of securities. But the point is that in every real-world issue of securities, the ratio of longs to shorts is heavily skewed towards the long side of the market. Well, that means as securities markets are rising or falling, it's not a zero-sum game. It might be a positive or negative sum game. Securities markets up, longs are winning and shorts are losing. And since there's a heck of a lot more stocks and bonds owned long than have been sold short, securities markets rising means net wealth creation. And that's basically the markets taking the view that the falling interest rates are making the present value of the future bond cash flows more valuable. Or equity markets are rising because of the expectation of rising earnings over time. On the other hand, if securities markets decline, now you see net wealth destruction. Because in a declining market, yes, the shorts are winning and the longs are losing, but since so many more stocks and bonds are owned long than have been sold short, declining securities market means net wealth destruction. Markets are taking the view that the value of those claims has been reduced. And just to put a number on it, to give you an example, if you look at the bear market in U.S. equities from the bursting of the internet bubble to that market nadir in October of 2002, about 2.5 years after the bear market began, there was something like $6.3 trillion of net worth destruction. That's the amount by which the losses of the longs exceeded the gains in the shorts over that 2.5-year bear market. Last thing about derivatives. Why are they called derivatives? And most of the time, the definition provided is so vacuous as to be almost uninformative, if not downright misleading. Because how are derivatives usually defined? Derivatives are most commonly defined as something that derives its value from something else. As I said, that definition is so vacuous as to be completely uninformative, and if you interpreted it too literally, it would be downright incorrect, because that implies that other markets have to move first and the derivative market would have to tag along. Well, if you've ever seen any of the old video clips about how the trading floors looked on the Chicago Board of Trade or Chicago Mercantile Exchange when they still had vibrant trading floors, as soon as news comes out, the traders are yelling and screaming and gesticulating wildly, trying to buy or sell or both as soon as the information is released. And that's because all markets are in the business of price discovery. Doesn't matter whether it's a securities market or derivative market. Now, price discovery is a big concept, and I'm going to grossly shorthand it here. But it's a shorthand way of saying all market participants would rather make money than lose money. Oh, I can say that in a more sophisticated sounding fashion. Market participants want to maximize their risk-adjusted return on capital. But the idea is you'd rather make money than lose money. And to make that the more likely outcome, you're likely to base your buy and sell decisions on some sort of research, be it fundamental, technical, or quantitative. And as market participants act upon the fruits of their research by buying, selling, short selling, increasing or reducing exposure to certain market segments, that causes the fruits of their research to be reflected in price. That's a grossly simplified explanation of what price discovery is. But all markets are in the business of price discovery. Now, if you look at the final two lines in that exhibit, what you see there are the generic formulas for pricing futures contracts or forward contracts and options. So the first of those two formulas, F, is the futures price. In fact, let's look at the next slide where it's detailed. So there you see F is the futures or forward price. S stands for the spot or the market price of the related asset or security. R stands for interest rates and T for time. So in words, the formula says the futures or forward price equals the spot price times 1 plus the rate of interest compounded over the time until the delivery of the futures or forward contract. And as noted behind R in the legend at the bottom, more properly that ought to be the cost of carry, shorthand for all of the costs or income related to collecting or I should say all the cost or income related to a holding of the underlying over the time to delivery. Now, and going back just a slide for a second, the bottom formula on the previous page is what's known as put-call parity, which says the value of the call should be equal to the value of the related stock plus the value of the put, where the call and the put are, of course, the same stock, but also have the same time to expiration and the same strike price. And minus X times e to the RT, well, that's minus the present value of the strike. Looking at either of those formulas, many people not familiar with the markets intuitively interpret the derivative value as the dependent variable and the underlying price, I should say the derivative price as the dependent variable, and the underlying price as the independent variable. That's the wrong way to look at it, remembering that all markets are in the business of price discovery. So I talked through the formula on slide 6, and it might seem that that's a logical way of intuiting the information as played out in the formula. But note on the next slide, by a simple algebraic manipulation of the formula, if I divide both sides of the equation by 1 plus the interest rate compounded over the time to delivery, whereas the top line formula, which is repeated from the previous slide, basically says that the futures or forward price is the future value of the spot price. After making the algebraic adjustment in the middle of the page, the bottom formula could basically be interpreted as the futures or forward price being the present value of the spot price. In other words, given the forward or futures price, I could calculate the fair value of the underlying asset. Just like given the fair value of the underlying asset, I could calculate, or given the current market price of the underlying asset, I could calculate the fair value of the futures or forward contract. Point being that either of the markets can move first. In fact, if you look at it statistically, Treasury futures typically move ahead of the Treasury market. Or to an even greater degree, S&P futures move ahead of the S&P actual index. Which market reacts first in the price discovery process is probably a function of concentration of resources. Resources being people, capital, and technology. Well, if to use the Treasury market to be specific, there are over 300 issues of Treasury bills, bonds, and notes. There's only 7 different futures contracts. That allows for a much greater concentration of the resources identified a few moments ago. And given the much smaller number of contracts to trade and the fact that futures will oftentimes have a volume based on their notional value of double the actual trading of Treasury securities, unsurprisingly, derivative markets oftentimes move first. But I'm not saying one ought to drive the other. They are interdependent variables. And rather than these formulas saying that one price is derived from the other, and that's of course true in an arbitrage pricing context, but if derivatives were given a name that was a descriptor rather than just a name, they would be called relatives, because that's what these formulas show. What's the right value of the derivative relative to the market price of the underlying? But that's a description. Their proper name is derivatives, but don't mistake a name for a descriptor. Sometimes names are descriptors, but oftentimes names are simply names. Well, so we're about halfway through the session, so let's move on to the foreign currency market. So foreign currencies. The foreign currency market is by far the biggest of all financial markets. I think I shared this statistic with you the other day, but if you looked at volume of trading on a major equity exchange like the New York Stock Exchange and the related electronic execution systems, a year's worth of trading on the New York Stock Exchange equals 2 or 3 days of trading in the FX market. Or compare the capital flows in the FX markets to international trade in goods and services. The volume of financial flows are 40 to 50 times the trading in goods or services. So the foreign currency market is huge. And as I also shared in one of the previous sessions, the dollar is by far the most important currency in these markets. The dollar is involved in typically about 85% of the total volume of transactions in the currency markets. And that's looking at the dollar value or the currency value of both sides of the trade. So that means the US dollar is involved in the vast majority of currency transactions. And in some cases, it's not because the buyer or seller of currency wants to own the dollar. It's just oftentimes cheaper to round trip through the dollar. If I hold Chilean pesos and I want to convert that into, I don't know, say Chinese yuan, well, it's probably cheaper to sell my pesos for dollars and then change my dollars for yuan rather than the cross rate between the peso and the yuan. Now, the currency market has a number of different segments. There is both a spot market, trading actual currencies, and a derivative market. And the spot market is where we'll do a trade today and settle 2 business days in the future. That's T+2. Any trade settling beyond 2 days in the future would be considered a forward trade. And forward trading in currencies is about twice the volume of spot trading. And then, of course, there's also foreign currency derivatives, futures and swaps and other things. Especially people not familiar with the currency markets, there's a lot of potential confusion because unlike most assets or commodities where their prices are expressed in a single currency, in the currency markets you're trading one currency for the other and you could price the transaction in terms of either currency. So every currency quote implies one currency relative to another. And just to lift the cover on the market terminology, they'll talk about a term currency and a unit currency in any currency quote. The term currency being the number of amounts or the amount of one currency that would be traded for 1 unit, the unit currency, 1 unit of the other currency. Now again, that's very abstract, so let's look at a specific example. And we see the dollar-pound exchange rate quoted 2 ways. This reflected the spot exchange rate between the dollar and pound as of a couple of days ago when I put this exhibit together. So one style of quoting is, and by the way, note the one that's labeled indirect, the other direct, that is very location specific. So I'm using the terms based on where I'm sitting, and I'm sitting just outside of New York City. And so an indirect quote based on where I'm sitting would be the amount of foreign currency per 1 unit of the domestic currency. So based on the current value of dollar pound, that would be 0.7765, so almost 77 hundredths and about 77 2/3 of a hundredth % of a dollar. Or equivalently, the direct quote, again, sitting outside of New York as I am, direct quote would be number of units of the domestic currency versus 1 unit of foreign currency. So the 0.7765 pounds per dollar would be equivalent to about $1.28, 7.79 cents per pound sterling. Now, of course, in theory, you could quote them either way to minimize confusion. The currency market will coalesce around one way or the other of quoting the currencies, and the currency market convention is the latter of those two, number of dollars per pound. But note the definition of direct and indirect. If I was sitting in the UK, the direct quote would be 0.7765 pounds per dollar, and the indirect quote would be the other. So these two are basically the same, with allowances for rounding errors. And for people that follow any particular currency pair, no matter which way you quoted it, they probably recognize what was the right relative value without actually sticking the currency symbols next to the quote. The problem, of course, arises once you get close to parity. If the dollar and pound were trading almost 1-to-1, unless there was a clear indication of which was which, or in other words, unless the market always followed one convention or the other, it would be potentially very confusing. And I don't mean to imply that all currencies are quoted number of dollars per one of the other currency. That's the way the US dollar is quoted versus the currencies of all the other English-speaking countries, the Aussie or Australian dollar, the Canadian loonie, the British pound, or against the euro. But many other currencies are quoted via the indirect method, again using the definition because of where I'm cited. So dollar yen is quoted yen per dollar. Swiss franc dollar is quoted Swiss franc per dollar. Why do some currency pairs quote one way and others the other? Just because. There's no particular rhyme or reason to it. That was just the convention that the traders in that particular currency pair decided to use to try to minimize confusion in trading. Now, how are currency values set? Well, some currencies have a fixed exchange rate versus either a reference currency or basket of currencies. Others float, although there's different ways of floating as indicated by this exhibit. So a fixed exchange rate, well, that would be like the Hong Kong dollar. As far back as about 1986, I think it was, the Hong Kong Monetary Authority fixed the exchange rate of the Hong Kong dollar versus the US dollar at 7.8 Hong Kong dollar to 1 US dollar, and it has defended that exchange rate so that it's always been within a slight differential of that value. But note, when a country commits to a fixed exchange rate, that means that they have to give up monetary independence because monetary policy has to be conducted so as to maintain that fixed exchange rate. Most currencies are allowed to float, although how much they're allowed to float depends. Generally, the currencies of most of the major developed economies are allowed to float relatively freely. Although if the currencies get too strong or too weak, there will oftentimes be interventions to prevent an extreme movement. Or a currency like the Chinese yuan. That's very much a managed float, as the Chinese government will go back and forth between fixing the value of the yuan against the dollar or trying to have it appreciate or depreciate at a controlled rate over time. Now, in addition to spot exchange trading, there is also forward contracts. In other words, we could agree to trade dollars for pounds today and settle 2 business days, Tuesday of next week, as long as that's Monday of next week, as long as that's a business day in the countries of both currencies. But we could also trade dollars per pound, say, to settle in 6 months. That would be what's known as a forward exchange rate, and forward exchange rates will not be the same as spot exchange rates. In fact, the forward rates will differ from the spot rates by the interest rate differential between the interest rates in the two currencies. And that forward exchange rate is not a reflection of expectations. It's based on arbitrage pricing, which we'll see briefly in the next couple of slides. And that arbitrage pricing relationship is what's referred to as covered interest arbitrage. And forward rate quotes can be presented like they were in the previous slide. In other words, they can be expressed in full as $1.2879 per pound, or forward rates can be quoted by a differential from the spot exchange rate. Outright is where you give the full expression of a quote, or forward point differential. What's the number of basis points above or below the spot exchange rate between the two currencies? Now, I'm not going to go through the next couple of slides in detail. You can look at the slides at your leisure by going to the Star Weaver website and looking at the recording of the webinar. But this shows you the arbitrage pricing relationship between the spot and the forward rate. So the forward rate between two currencies, currency A and B, and there's a dollar-pound example on the next couple of slides, would have to be equal to the spot exchange rate between the two currencies times the ratio of 1 plus the interest rates between the two currencies. And rather than linger on this abstract example, let's look at a specific example. So again, this is based on current exchange rates and interest rates between the dollar and pound as of Monday of this week. So there we see the spot exchange rate expressed by currency market convention, dollars per pound sterling. And there you see the 6-month interest rate in the dollar and in the pound. Those are 6-month LIBOR in both cases. And so at the bottom you see the formula for calculating the forward rate, which is the bottom number in the exhibit. So the forward rate is the spot exchange rate, the $1.2979 per pound sterling, times 1 plus. Now note in the parens you see the quoted rate, that's the annual rate, prorated over the time until the delivery of the contract, the 0.5 representing a 1/2 of the year. So the annualized rate adjusted for the time to delivery could be called the periodic rate. So it's the spot rate, the spot exchange rate, times the ratio of 1 plus the periodic rates in the two currencies. And that 129.42, that would be the 6-month forward exchange rate between the dollar and the pound. And note that does not reflect expectations. That's purely a reflection of the interest rates, the rate at which your dollar position would be growing over time, the 1.44%, and the rate at which your pound position would be growing over time, the 0.46%. So I could borrow one currency and use it to buy the other. The borrowed currency I'd be incurring an interest expense on. The currency I purchased I could be earning an interest rate on. And so that 6-month forward rate, that is the rate that we have to see at any other rate that would violate the arbitrage pricing relationship and thus would give someone a chance to make money risk-free. And note this is a simplified example because in the real world time matters and they use different day count conventions in the dollar and the pound. Note in this case the 6-month forward rate is exactly the same, but oftentimes the difference in day counts would result in a slightly different exchange rate if you just use 0.5 for the half year rather than using the appropriate day count conventions as I have in the second slide. And as time won't permit, I'll just give a general indication. As was just shown, forward rates are no arbitrage prices. They have nothing to do with expectations. Oh yes, many basic books will describe a forward price or a forward interest rate as a market expectation, but where arbitrage pricing holds, forward rates and prices are simply no arbitrage prices. The prices at which no one can make risk-free money by buying and short selling of the different assets one versus the other. Now, the spot exchange rate will vary over time, primarily driven by factors that increase the demand for or reduce the supply of a currency or vice versa. And what you see listed at the bottom of this page are factors that would affect the supply and demand for a currency. followed by an exhibit that provides some detail, showing the same 5 economic factors in the middle column of this exhibit, and then showing, depending upon whether it was a greater or lower amount, deficit or surplus, how those different economic factors would likely affect the spot exchange rate for the between a currency pair, depending upon how those economic factors are changing. Well, let's move on to equities since we're about to the last quarter of the session. So equities, common equities represent ownership in the company of the issuing corporation. We talked about debt securities last week. If you buy a corporate bond, in effect, you've lent your money to the corporation. Or if you bought the bond in the secondary market, you bought the claim that the original lender had when they bought the bond at issuance. And some terminology for stocks. Some of the terms you'll run into are authorized, issued, and outstanding, as well as treasury stock. Well, authorized shares are the number of shares the company is legally authorized to distribute to investors. The initial authorization typically approved when the company is granted a charter by the state or national government that approved the issuance. Issued shares represent shares actually sold or given away as compensation, but generally sold to investors to raise cash. However, it's only the shares outstanding that represent the rights of ownership, the right to receive distributions made to owners, the right to elect the members of the board of directors. And the shares outstanding are the shares that have been previously issued, less any shares that have been repurchased by the company. That's what treasury stock refers to. And in the U.S., now these laws vary from country to country, but in the U.S., when a company repurchases its stock, those shares are retired. It does not vest ownership control in the hands of management. Treasury shares show up in the balance sheet, but they no longer have existence as ownership claims in the company. They're simply recognized on the balance sheet for accounting purposes. And under distributions, there can be dividends in cash or in stock. There are also stock splits. Understand that stock dividends and stock splits are both ways of issuing additional shares to existing shareholders. And while the accounting for the two is somewhat different, although the terminology is very complex and time doesn't permit us to go into it, in neither case does that represent a change in percentage ownership, because whether it's a stock split or a stock dividend, all of the existing shareholders are seeing an equal adjustment to the number of shares they own relative to all the shares outstanding. So no existing owner's position is altered by a stock dividend or a stock split. Stock buybacks, on the other hand, and that's the treasury stock referred to earlier, that represents an actual retirement of shares by the company buying shares back from existing holders at a price typically reflecting the current market price of the stock. Although, again, that gets complicated and there's other ways of structuring buybacks. The potential benefit of a stock buyback is it shrinks the number of shares outstanding, which means each existing share represents a slightly larger percentage ownership of the company, or depending on the size of the buyback, maybe a significantly larger percentage ownership of the company. And so stock buybacks should result in share price appreciation, as each share now represents each of the still outstanding shares represents a larger percentage ownership of the company. In effect, the pie, each piece of the pie is a little bit bigger. Now, measuring the equity market as a whole is usually done by looking at various indices. I've got a bunch of U.S. indices listed here, but there's many global and other national indexes. So while I'm showing the U.S. indexes here, the Dow Jones Industrial Average is probably the most widely known by people outside of the financial businesses. But it's a very narrow index. It includes only 30 different company stocks. Market professionals are much more likely to follow the S&P 500, as it includes many more companies and therefore is a much more representative index. The NASDAQ 100 includes only the 100 largest companies traded on the NASDAQ stock market. And the Russell 2000 is an index that includes only relatively smaller companies. We'll talk about market capitalization in just a moment. But again, there are many global indices or other national indices. So the FTSE 100, the Financial Times Stock Exchange 100 is the quintessential UK index. Or the Nikkei 225 is the Japanese index that is probably analogous to the Dow Jones Industrials in terms of its recognition, although the TOPEX index is a more representative index for market professionals, a la the S&P 500 in the US. Now, market cap, short for market capitalization, is a way of referencing the relative size of a company. Market cap or market capitalization is computed by looking at the number of shares that represent true ownership of the company. That's the shares outstanding we talked about previously, times the market price per share. And you'll hear reference to large caps, mid caps, small caps, micro caps, as I've shown there, or even mega caps. That's the biggest of the big. And you'll note next to large caps, I say approximately 10 billion plus. Well, I say approximately because these capitalization distinctions are not written into law or regulation. These are definitions that grow up consensus by market participants. So some might define large caps as 8 billion market cap or bigger. Others might define large cap as 12 billion or more. And these definitions change over time. When I worked for Citicorp Investment Services back in the early 90s, a large cap was 5 billion or larger, or to some people 6 billion or larger. So as the markets have gotten larger, the definitions, the cutoff points between these different divisions have gotten larger and larger. So small caps are generally defined as companies with market caps of less than either 1 or 2 billion, and micro caps, the smallest of the small caps. Well, again, you see the range there, so I don't have to read it out. Now, what's the significance? Well, generally over time, small caps outperform large caps, and that shouldn't be surprising as smaller companies tend to be riskier. They're typically in one or a smaller number of market segments and probably much less geographical diversification of their operations. Small caps also probably offer the best opportunity for outperformance because there's a greater chance of something being overlooked. A Google or an Apple will have dozens of Wall Street firms giving investment opinions and internal analysts at all the major asset companies following them as well. Many small caps might be totally unfollowed, or I should say uncovered by analysts, or followed by a relatively small number. And when I say small caps tend to outperform, that is over time. You can see many consecutive years of outperformance by large caps or mid caps. But when small caps outperform, they tend to outperform by a lot. So they might outperform only in 1 or 2 years out of 10. And then despite the fact they've underperformed in the balance of that decade, they nonetheless might have a cumulative return over time that outperforms the mid caps and the large caps. But note, this is talking about entire market sectors. Small cap companies are also much more likely to disappear. And if they disappear, the equity becomes worthless, of course. A little bit more on equity markets before we wrap up. Equity returns on average tend to be higher. Nominal, in other words, not inflation adjusted, long-run average returns on equities are probably somewhere in the range of 9 to 11%, depending upon when you start and close your sampling period. Whereas on fixed income securities, long-term, it's probably more in the range of 5 to 6%, and short-term, 1 to 2% or even less, T-bills and things like that. Note those are very long-term averages. Over the course of the 90s, the treasuries, long-term treasuries returned between 9 and 10% on average per annum. On the other hand, equities returned 17 to 18% on average per annum. However, in the aftermath of the financial crisis, obviously treasuries greatly outperformed equities. So in the long run, equities tend to outperform, but you know what John Maynard Keynes said about the long run. In the long run, we're all dead. We live in the short run. So don't take long run outperformance of equities as guaranteeing outperformance in the short run. And while there are many different ways of valuing equities, one common way of disaggregating the equity market, or investing styles anyway, is between growth investing and value investing, where growth investing is based on assessing companies on their growth, usually over time growth of earnings, but it could be growth in sales, which hopefully ultimately generate growth in earnings over time. Whereas value investing is not so much looking at the future as identifying a company that today seems undervalued for some reason. It's a gross simplification, but since time is short, we'll have to leave it at that. Now, common ways of valuing equities. Most analysts use an earnings multiple valuation, although as it notes there are many valuation multiples based on earnings or cash flow or sales or book value. Some analysts say they do a discounted cash flow analysis, and cash flow to shareholders could either be the direct payments to them, the dividends, or it could be the free cash flow, the cash flow in excess of the obligations to meet other expenses and debt service and the like. Next page shows a sample discounted cash flow valuation formula, and it's based on free cash flow to the equity holders. You can see the definition at the bottom, so I won't try to read that since time is short. But note that anyone who says they're doing a discounted cash flow analysis is being somewhat misleading, because they're generally only projecting cash flows or dividends or whatever we're talking about 3 or 4 or 5 years into the future, and then beyond that point they're assuming everything is growing at a constant rate or the level of risk is constant. Note, when you make that assumption about constant growth rates and constant risk beyond 3 or 5 years, that means 92 to 97% of your estimated value is associated with the period of time over which you're assuming everything is constant. So don't believe anyone who says they're doing a discounted cash flow analysis, because the vast majority of the value they're estimating is based on that period where they're assuming everything is constant. Most Wall Street analysts use a valuation multiple approach, and most of them use the PE ratio, which is the top of those 4 ratios. And let's look at the last 2 slides, which look at that in more detail. So the PE ratio will compare the current market price per share to the earnings per share. But then the question becomes what earnings are we using? Many are what are known as trailing or historic PEs, where they're looking at the last 4 quarters actual earnings per share. That might seem a good metric to use because we're looking at the actual reported earnings, although if anyone is familiar with financial accounting, even reported earnings are somewhat questionable. But that's somewhat schizophrenic because the historic earnings are backward-looking statistics and markets are presumably discounting mechanisms. So in other words, most valuation approaches are not based on looking backwards, but rather looking forwards. What are the next 4 quarters estimated earnings per share? And as much as we're talking about a PE ratio, understand how analysts are coming up with a target price. They're going to estimate the earnings per share over the next 4 quarters or the 4 quarters beyond their target date, and then come up with an estimate of what earnings multiple the market's going to be placing on that company's earnings over time. So say for instance that, well, let me get here. Say for instance, I'm sorry about that, it kicked me out. I guess I'll just have to do it in Word since GoToMeeting doesn't want to let. Yeah, here we go. Let's say, for instance, we forecasted the earnings at $12 per share. And even though the company is maybe currently trading at a PE ratio of, say, 13, that is, the price is 13 times the current earnings per share, let's say we think this company's earnings are going to grow over time. So we're thinking that that the market is going to start valuing this company at 15 times its future earnings once the market recognizes that the earnings per share are likely to grow more rapidly. Well, you'll note that would lead to a target price of $180 per share. So that's a grossly simplified example, but just to give you a basic idea of the way analysts actually try to come up with earnings targets, or I should say target prices, that is a brief illustration of that idea. So since we're just about at the end of the time, I'll wrap up there. And of course, I'd be happy to respond to any questions any of the participants have. So please, if you have any questions, ask away. Otherwise, I will hope you all got a lot of good information over the course of the session.